G'day and welcome back to Dividend Investing with Lincoln. So look, people often ask me, how do you get good yields? How do you get good income when you're investing in dividends? You know, for example, in New Zealand, they often think about real estate as a great way to drive investment income. Now, when you're investing in dividends, yes, there are some slow burners, some slow growers, there's dividend growth investing, but there's also other options as well. So here today, we're going to talk about business development companies, BDCs, and we're going to think about how we can use those to juice our returns and boost our returns and become better investors. So, let's get into it. Welcome back. Hey look, I am in the Stock Rover tool today. I've got a number of different tools that I use. When I'm looking at some elements of investing for dividends, I do find that Stock Rover is quite a useful tool. Now today, as we said, we wanted to look at business development companies, or BDCs, providing finance to growing and emerging companies in many cases, sometimes helping out companies that are in distress. Sometimes BDCs do take an equity stake, sometimes they just lend, and they're a lender to these companies. So I want to just quickly talk about two major BDCs that we might know about, and have a quick look at some of the key things that you need to think about when investing in BDCs. So I'll be talking about Main Street Capital and Ares Capital as well. Two large BDCs, well known. Now Main Street Capital, they pay a relatively low dividend yield for a BDC, but they do grow it on a regular basis, and they've been slowly growing it. Now, they've also had a reasonable price appreciation as a company. Now, one of the key reasons that they can, and that sort of enables us and drives us, is the increase in earnings over time, and that is largely going to be driven also simply by the fact that they take equity stakes in some of the companies that they invest in. So let's have a quick look at Main Street Capital now, and do remember, if you like the video, click subscribe, click the thumbs up, and pass on the video to somebody who you think might benefit from it. So this is Stock Rover's screen here. This is for Main Street Capital, and this is the Insights panel. So it gives us a bit of a description about the company and quite a lot of other details. Now, if we click down here, we can see dividends in the corner here. We can see Main Street Capital has about a 7% dividend yield at the moment, and a relatively low 5-year dividend increase of 3%. Now, obviously, that's a little bit below inflation at the moment. I can live with that because over time, the 7% dividend yield is quite healthy and quite substantial. And what I want to do is I just want to quickly get an feel for what the analysts think about this stock. So there's a whole load of detail here as well. Overall, we can sort of see the analysts suggest that we hold this. They're not sort of suggesting we race out to buy it, and they're sort of not suggesting that we ditch it either. Most analysts are suggesting hold. One analyst is suggesting buy, and that's been relatively static over the last 3 months. The price target is about $42 compared to the current price of about $38, $39. So there could be about a 10% potential increase to that price target. So that's quite nice. Let's have a look at these dividends. So we can sort of see over time here, looking back in time, we'll sort of skip through to 2010 post-financial crisis. So we're sort of paying 13 cents a share per month. Increases to 14 cents, increases to 15 cents in 2012. Skip through this, we can sort of see 18 cents. We can see some special dividends pumped out there. 2017, 18 cents. 2020, 20 cents. 2021, 21 cents. Now, if you think about this, through 2020, through the pandemic, paying the same 20 cent per month dividend, and then into 2021, increasing the dividend, and then again in 2022, increasing the dividend again, with another bump in dividends planned for 2023. So we're not talking about large increases, we're not talking about massive increases, but we are talking about a reasonable yield today, and small increases over time. Now, BDCs, if we look at this chart here of returns, we can see the total return Since this period of inception here, 2007 through to today, we're talking about a 450% total return. So this includes taking your dividends, reinvesting them, etc. Now, from this chart, we can see this total return here. This dark blue represents a very big proportion of the total return, and that's the power of the dividend here. Now, the price change here we can sort of see comes up to about 150% over that 15 years, which is reasonable. It's not groundbreaking or anything, but we can sort of see the power then of this larger dividend payout over time. So we've got a reasonable option here. I have a small position in Main Street. It isn't the highest dividend yield BDC, but it does have that slow, steady, incremental increase in dividends, and it's also got there in this grey, this increase in price changes over time. Now, like many of these companies, if you can pick them up at a good price, when there's a bit of craziness and panic in the marketplace, you can often make some pretty good deals. Now, I'm going to switch over now to Ares Capital. It's another large BDC. I'm going to just switch back to the summary panel. Ares Capital, it's got a dividend yield of nearly 10%, so substantially higher than Main Street Capital. It does increase the dividend a little bit less than Main Street Capital does, but it's got the higher starting dividend yield. If we look down here at the analyst estimates, we can sort of see that it's got a strong buy. I'm going to flick over to the analyst tab. We're going to get a bit more insight. So in general, most of the analysts are listing this as a strong buy or a buy. Now, there's a relatively small difference between the current price of about $19.7 to the analyst average price target of $21. So there's a potential there for a little bit of further improvement, but this is rated as a strong buy. Now, if we begin to look at this price chart here in terms of the dividends and the total returns here, this is, I guess, what we tend to see with most BDCs. Ares Capital lends money and takes, I think they take some equity positions, but not as many as Main Street Capital. Now, what that means is most BDCs sort of mirror this. The price change, it fluctuates over time, sometimes lower, sometimes higher. But over time, basically, there's been no change in prices. Now, what this means is if you can pick it up in the depths of the global financial crisis or the depths of the period here of the pandemic, it means you can sort of ride those price increases up when they do happen. And you'll see instead that most of the total return here is driven by this blue section of the chart here, the total returns, which is really being driven by your dividends. And that's a sort of a common pattern for most BDCs. Ares Capital pays quarterly. You can see after the global financial crisis, we're talking about 35 cents a quarter. 2012, 38 cents. Switch through to 2019 up to about 40 cents. We can see these special dividends coming through here of 2 cents a quarter. 2022, we can see that the regular dividends are 43 cents with a special dividend of 3 cents a quarter, and a boost here in this final quarter to 48 cents per share, which is actually quite a sizable increase from the 43 cents a share in the previous quarter. So Ares Capital, it's got a good reputation. It's been here for a while. We can see this total return is not as strong as Main Street Capital, but it does present you with the opportunity for stronger dividend yield now, a little bit of growth over time, but you're going to be relying more on this income for your total returns than you would with Main Street Capital. So look, BDCs can drive long-term success. If you can get them at a good price, you can get a good dividend yield on the money that you invest. Remember, the lower the price is, the higher that yield is going to be. But not all BDCs are created equal. The large, stable ones with history like Main Street or Ares, they tend to increase their dividends over time, they tend to hold them stable, they tend to grow. And that is really what we should be looking for, I think, in BDCs. They won't necessarily be a core part of your investment portfolio, but they can certainly juice, they can certainly add to, they can certainly help bump up your dividend income, and that's one of the reasons why I do like BDCs. So look, if this is helpful, if this is useful, please hit that subscribe button, hit that like button, and I will see you in the next video.